Dear fellow traders, in this video I would like to talk about a price pattern that is very common between tech companies after their IPOs. Soros, in his book published 1995, Soros and Sources Staying Ahead of the Curve, says the prevailing wisdom is that markets are always right. I take the opposition position. I assume that markets are always wrong. Even if my assumption is occasionally wrong, I use it as a working hypothesis. It doesn't follow that one should always go against the prevailing trend. Now, I would like you to read two of my previously published analysis in 2021 before Bumble IPO and before Coin IPO, or the first day they became public in trading. If you're looking at this one, on February 21st, 2021, I mentioned even big companies like Twitter, Snap, Facebook, Spotify, Pinterest, they lost 50 to 85% of their market cap in the following months. So applying the same rule, I ask most people not to participate in Bumble or Coin IPO on those days. Here you can see that I mentioned two possible scenarios for active traders and long-term investor, and recommend both of them not get involved with Coin when it was between $250 and $400 on the first few days of trading. But having said that, it looks like there is a solid trend that if we find such trend, we can use it in our favor. Let's look at the Spotify. If you are looking at the Spotify 20 months after the company was go public, it was trading 45% below the all-time high while making $500 million more, or like 35% compared to the all-time high. The same was true for Palantir. If you are looking at Palantir after 23 months, it was trading 86% below its all-time high while it was making 50% more. But now you know what happened. From 6 to 64 or 65 happened in less than 2 years. DoorDash, another example. You can see the stock tanked more than 83% while it was 70% more in revenue after 21 months. But if you are looking at the stock price is quadruple in the past few months in a very symmetric fashion and in an exponential way. This is true for Palantir and also for Spotify. Having said that, let's look at a couple of examples that can follow the similar pattern. Path, 39 months, tanked 88% while making 7% more. Very similar to those examples. Coursera, or COUR, 42 months, making 70% more, 89% below. Confluent, CFLT, after 33 months, making 110% more, and the stock tanked 81%. Asana, or ASAN, after 35 months, Asana making 70% more money, but the stock tanked 92%. Sentinel One, or S, making 200% more while trading 83% below after 30 months. Pretty much similar pattern. Freshworks, after 35 months, making 80% more in revenue, the stock is trading 79% below its all-time high after the IPO. AI, or C3AI, after 45 months, the stock trading 89% below its all-time high while making 85% more. Upwork, 37 months, making 50% more in revenue, the stock is 86% below its all-time high. So if you're looking at all these examples that I made based on what has happened before in Palantir, DoorDash, or Spotify, or other big tech names, there is a pattern. We see a bubble when stocks go public, then we see a very fast crash. Then it start going sideways while the revenue increasing. Then at some point market reverse its mistakes again. So we can say the bubble at the IPO date is market mistake. The crash is a correction to that mistake. Then the stock, because the huge decline caused uncertainty and hard for other investors to trust. Although the revenue goes up, the stock goes sideways. And then again, markets start looking back and say, okay, maybe we should rethink about the future of these companies that their revenue increase exponentially. And it happens like every quarter. All these examples that I showed you, every single quarters, they earn more money than the previous one. So this is very important. Or sometimes it's just one or two, but if you're looking at that, it's pretty much the same. So we can see a constant increase in the revenue while the price doesn't go anywhere. But and most of them are tech companies. Having said that, there is something we call the survivorship bias. Survivorship bias is a logical error that occurs when you focus only on the individual or things that survived a process, while overlooking those that didn't due to their lack of visibility. This can lead to overly optimistic conclusion because the sample analyzed is not representative of all the entire population. In investment performance example, we can say, okay, funds that survive over decades appear to outperform better. Many underperforming funds closed and are excluded from the analysis. So in real world, the performance of active funds is often overstated because the failures are left out of the data set, or as Nassim Nicholas Taleb referred to them, they are like silent data. So consider this in your asset allocation. Never invest more than 5% in any setup like this because they can go bust. However, uh, it could be very surprising if you see some company that for past 4 years increased in revenue exponentially go bust all of a sudden. But the opposite is very true. So there are lots of companies go public without any, like literally any revenue, and they go bust and they get delisted from the stock market. So we are only talking about stocks with the certain pattern. They should have history of like 3 to 4 years, increase revenue every quarter, the price tank 80% and didn't go anywhere for 23, 20 to 20 to 30 months. So this is a kind of a setup that we are looking. Another criteria for this could be they should be tech companies. Be careful. Most people think tech company and biotechnologies uh, are the same. They can experience exponential growth. However, for biotech companies, because they need FDA approval and everything uh, like that, is harder to reach exponential growth. But once they did it, once they make it, it is good. But look at the example like Moderna or mRNA. It go from a couple of bucks to I think it was $23. Then it goes all the way to 495, and then now it's back because people didn't like the COVID vaccine, and you know the rest. So be careful. I prefer tech companies to biotech companies because they are not like um biotech companies. They don't need FDA approval or anything like that. And once they find their customer base and they start growing, they usually stay in the game for a long time until a rival company disrupt their revenue stream. Thank you so much for listening to me. I hope this you find this helpful, and these are long-term ideas that can be hold for 2 to 3 years sometimes. Thank you, and have a happy Thanksgiving Day on Thursday.